Let's talk about the uncertainty that seems to be dominating so far into what is the very early weeks of 2026. And again, the landscape seems uncertain geopolitically, even economically as well. How is that shaping up some of the discussions you're having with clients?
Well, it's certainly been an abrupt change because we ended the year with, it seemed like uncertainty becoming less and less of a factor. There had been a lot of talk about tariffs and things like that through 2025, and I think the tariff landscape was more or less known. It might not be liked, but it was known.
Yeah.
And so we went into the year, I think most investors thinking 2026 is going to be a pretty good year, and we can talk about that.
Yeah.
But obviously, it's geopolitics that really have changed things. We saw what happened in Venezuela, which surprised people, and now Greenland.
Yeah, what impact do the geopolitics actually have on capital markets? I mean, because it seems to be a case a lot of the times where it dominates a lot of the news, but actually in reality, very short-lived impact on markets.
That's right, and I think that's what's playing out now, although certainly we're in territory as it relates to Greenland that we've never really seen before. So we'll see how it plays out. The next few days are actually going to be quite important.
Yeah. Do you see signs? I mean, perhaps it's a little bit early, but earlier on, my colleagues were talking about the potential for the Sell America trade to come back again. Last year there was a similar episode where people tested this thesis of U.S. exceptionalism. Are you beginning to see signs of that happening, or at least discussions?
Not really. I mean, there's certainly discussions around it, but it's not yet showing up in the numbers. And as you know, last year, there was that same narrative, and we saw a little bit of it, but certainly by mid-year last year, that was basically over. And not only did we see a reversion back to the U.S., but also an over-indexing on equities.
Okay, so would you say people are actually overweight right now, U.S. assets?
They would be overweight assets, and then they're also at an equity level that we haven't seen in over 15 years.
Okay.
So there's a lot of optimism, obviously, about the economy.
Okay, so let's circle back to what you were saying at the beginning, which is a couple of weeks ago, before the geopolitical storms, various geopolitical storms that have hit, most sentiment was pretty positive going into 2026.
And it remains positive.
Okay, and why? Why is that the case?
I think that if you think about it, there's a lot of factors that are setting up the economy to be quite good, led by the U.S. Mm-hmm. So if you think about it, there's the big, beautiful bill, which the real impacts of that in terms of business investment, in terms of the tax breaks, you've got tips. The average American is actually going to be taxed less. So that'll drive some consumer spending. But you've got a lot of other factors out there. I think tariffs had, again, up until recently, had been more or less factored in. And so now we know how to operate under those. You've got the dollar depreciation, which should help exports. Even things like the World Cup coming to the U.S. and North America broadly will drive a lot of spending. So the tailwinds in the U.S. are quite strong.
Yeah, I forgot about the World Cup. That's actually a good point.
Yeah.
How much of a swing factor is the Fed going to be? I mean, the market is pricing in about 2 rate cuts for 2026. And certainly the data recently has actually been quite robust.
Yes.
But you're going to get a changing of the guard. So how do you see that playing out and its impact on markets?
So I think you're going to get a change in the guard. Certainly a new Fed leader will have a lot of impact on direction. But over time, less so than I think people think. I mean, there's a lot of, if you will, safeguards in the system. I mean, the governors themselves have 14-year terms. The chair has a 4-year term. So you'll see some change for sure. But whether it'll be a departure from the way the Fed operates, which is very data-driven and what's actually going on. And right now, the Fed's facing, on the one hand, declining inflation, on the other hand, a pretty robust economy, and what's uncertain really is unemployment.
Yeah. Do you worry about the challenges to Fed independence?
I don't think it's good when there's a perception that the Fed is not independent. I actually believe what I just said, that there's a lot of institutional safeguards. But one of the reasons the U.S. has the position it does in the reserve economy is there's a lot of faith in that, and we need to make sure that the faith in that system is maintained.
Yeah. One of the big topics of discussion last year was private credit. I'm curious to see what State Street is doing in that part of the market.
So we operate in two areas in that. The largest area is we service a lot of the private credit operators, right? The large private credit firms. And as they're growing, we're growing. And then, of course, last year we announced the partnership with Apollo, where we put private credit into a credit ETF with them. It was the first of its kind, and it enabled private credit to be available in that form. It's very conservative, purposely so, because we want to make sure that it works. But there's two things going on. One, there's an appetite for credit. And two, it's really what we call the democratization of finance and making these products in a safe way available for a broader group of investors.
Yeah, and what about the compression of spreads that we've seen in that area? I mean, you could say, quote unquote, the easy money, so the early spread compression has actually occurred.
Yeah.
I guess you have to be a lot more discerning about the opportunities now.
Yeah, and usually compressed spreads mean that the credit environment is quite strong, and I think all the evidence continues to point to that. But with compressed spreads, the underwriters have to be very careful, right? Because there's little margin for error.
Yeah, there was a moment last year where I think people were beginning to get a bit concerned about the underlying credit. You had a couple of defaults. You had Tricolor and First Brands. You had Jamie Dimon talk about potential cockroaches in the system, but we sort of moved past that now.
Yeah.
What do you think is the biggest risk to global markets? Where would the pullback come from if there is a catalyst?
So I think on the private credit side, I think it was, in my mind, overblown. If this had been a standard bank loan and a standard bankruptcy, it wouldn't have gotten the same attention. And the realities are there were banks involved in that credit, there were private credits involved in that credit, and it was a bankruptcy. I think, though, when you have times of credit stress, that's when the good underwriters get separated from the bad underwriters. Yeah. Do I think it'll be a systemic risk? No, I don't think so.